Hey everyone! If you're new to my channel, my name is Ruba and I love to talk about all things personal finance. Today, we're diving deep into something that affects all of us, our credit scores. Whether you're looking to buy a new home or buy a new car, or just to improve your financial health overall, boosting your credit score is a must-do. Unless you're blessed enough to be able to be 100% debt-free and you're able to pay for everything that you want in cash, a credit score is one of the most important aspects of your personal finance. Today, I'll talk about practical strategies that you can use to achieve a perfect credit score. So, what exactly is a credit score and why does it matter? A credit score is like a grade that tells banks and other lenders how good you are at handling money and debt. This score is given by a credit rating agency. The main credit rating agencies in the UK and the US are Experian, TransUnion, and Equifax. When you're in school, your teachers keep track of everything from your homework to your test scores, and a credit rating agency works kind of like that. But instead of grading your schoolwork, they're grading your financial behavior. They gather all this information about your financial behavior and boil it down into a credit report, which is like a quick summary grade. The score tells potential lenders how risky or safe it might be to lend you money. The higher your score is, the better you look to lenders, because a high score suggests that you're good at managing your money. The score isn't universal, as scoring methods differ between countries and differ between credit rating agencies because they look at different criteria and they weight that criteria differently. So it's quite possible to have a perfect score from one credit rating agency and to have only a very good one from another agency. A credit score matters because it affects whether or not you'll be able to borrow money and at what interest rate. If you're thinking about big purchases like a house or a car and you can't pay for it all in cash, then you're going to need a loan. And when there are large sums of money involved, even a slight difference in interest rates can have a big impact in how much you end up paying. If your credit score isn't great, you might get turned down for financing, or you might not get the full amount that you need. And the interest rates could be higher too. This could really impact your quality of life and the things that you're able to afford to do. Even if you're not thinking of applying for a big loan anytime soon, your credit score still matters for things like renting a place. Plus, credit reports usually track your history for something like the last 6 years, so it's smart to start improving your credit score now. That way, when you do need to borrow money, your report will look as clean as possible with as few negatives as possible. The first step to building your credit score is to actually have some credit or borrowings in your name. That might seem counterintuitive, because you might think having no credit shows that you're good with money and pay for everything in cash. However, before a lender risks any money with you, they want to see that you have a history of having borrowed money before and having paid it back. So it's important that you open up credit lines in your name. The kinds of credit that you can open up to start a credit file are things like a phone contract, a credit card, car finance, utility bills. There's a long list to choose from. This is especially important if you're married because sometimes the default is just to put all the bills and all the credit in one person's name for convenience or whatever, but it's good to make sure that each of you has some bills in their own name. Secondly, it's important to pay your bills on time. Having some credit is important, but it's equally crucial to show lenders that you're reliable with your payments. Even one late payment can have a disproportionate negative impact on your credit score. I find that setting up automatic payments for all my bills helps me to avoid missing any deadlines by mistake. I also make sure that my budget is set up in a way that my account always has enough money for all my direct debit payments when they go out. It's also made it simpler for me to manage everything by having all my bills go out of one particular bank account. It just makes keeping track of everything a lot easier. The next good credit building habit is to have different types of credit. Having different types of credit can really boost your credit score. Lenders want to see that you can juggle various different types of credit responsibility. This means having both revolving credit like credit cards, installment credit such as a mortgage or a car loan payment. Credit scoring models take into account the type of credit that you have, and a diverse credit profile can make up about 10% of your overall credit score. By showing that you can handle different types of credit, you prove your financial stability and reliability to lenders. So mixing it up with a variety of credit accounts can significantly enhance your credit score and make you appear more creditworthy. Another important factor with your credit is how much of it you're actually using. You're an attractive person to lenders when they can see that people are willing to offer you a lot of credit, but you have enough discipline to not need to use it all. So when it comes to your credit card, for example, a good rule of thumb is to aim to utilize no more than 25% of the available credit. This indicates to lenders that you're a responsible borrower and you're not overly reliant on debt. It's also best to watch the number of credit applications you make and to make sure not to make too many new applications of credit within a short space of time. Opening new credit accounts can temporarily lower your score. So if you have any big credit applications coming up, like a mortgage application, try not to make any new credit applications for as long as time as possible before the mortgage application, at least 6 months if possible. Now, this next point seemed really random to me when I first heard it, but this is useful for a couple of reasons. Registering to vote. Firstly, it helps with address verification. When you're on the electoral roll, it serves as a reliable way for credit agencies to verify your address. Lenders use this information to verify your identity, which helps in speeding up credit applications and reducing the risk of fraud. Registering to vote also helps your credit file completeness. Being on the electoral roll shows stability and helps keep your credit file complete and accurate. This makes lenders more confident in offering you credit. Some credit scoring models factor in whether or not you're on the electoral roll. While it may not have a massive impact, it can still be beneficial. So it's important to register at your current address and remember to update your address whenever you move house. The longer you've been registered at an address, the better for your credit score as well. So TransUnion, for example, looks at a period of at least 6.5 years of being registered at one address as a positive contributing factor to your credit score. Point number 6 that will help your credit score is making sure your address is consistent. This is linked to the previous point, but anytime you move house, it's easy to forget to update your address for all your different accounts. But it's important that all your accounts have the same address, or else this could negatively impact your score. So whenever you move, it's worth spending some time listing all your bank accounts, credit cards, and any other financial accounts that you have, and making sure that they're all registered to the same name at the same address, which matches the electoral roll as well. Next, let's talk about the big 3 things to stay away from to make sure you have a perfect credit score. And those big 3 are county court judgments, also known as CCJs, bankruptcies, and individual voluntary arrangements, also called IVAs. These can have a serious impact on your credit score. But what exactly are each of these? A CCJ is a legal order issued by a county court when you fail to repay money that you owe to a creditor. Bankruptcy is a legal status for individuals or businesses that can't repay their debts. When you've been declared bankrupt, your assets may be used to pay off creditors, and your financial life is under court control. An IVA is a legally binding agreement between you and your creditors to pay off your debts over a set period. It's an alternative to bankruptcy that allows you to repay a portion of your debts while protecting your assets. If you've got any of these on your credit record, lenders consider this a big red flag, which makes you higher risk, which means tougher loan approvals and even higher interest rates. Staying clear of these is key because they can linger on your credit record for up to 6 years or 10 years in the case of bankruptcy. Imagine making a mistake at 24 and ending up with a CCJ. That might mean even if you can save up for a deposit for a house, for example, you may not be in a position to actually consider buying one until you're at least 30 years old. Because even if you can get a loan, the interest rate you're offered might just make it ridiculous. The next point is having a mortgage can positively impact your credit score as long as you make your payments on time. It shows lenders that you can handle significant long-term debt responsibly. Each on-time payment adds to your positive credit history, but missing a payment can severely hurt your score. Ultimately, a well-managed mortgage boosts your credit worthiness and improve your score over time. The next point is minding who you are financially linked to. Who you're financially linked to can have a pretty big impact on your credit score. If you share any joint accounts like a mortgage, a joint bank account, or a loan with someone, their credit habits can affect you too. For example, if your partner misses a payment on a loan, it could drag down your credit rating too, even if you've been perfect with your finances. Therefore, it's worth considering each other's credit scores before deciding whether or not you want to have any joint accounts. If you want to do something like buy a house with your partner and they don't have a good credit score, it may be worth taking the time to work on improving their score first before you open a mortgage together. Point number 10 is to keep your credit accounts for long. Lenders love seeing a long, stable credit history because it shows that you're experienced in managing debt. So if you've had a credit card for over a decade and you've always kept up with all your payments, that's gold for your score. On the flip side, if all your accounts are fairly new, it can make you look like more of a risk to lenders. The bottom line is, the longer that you've managed your accounts well, the better for your score. Sometimes, even if you no longer use an account or need an account, it's worth keeping just to give you that boost on the length of time that you've had it open. So with a credit card, for example, if you no longer like spending on your credit card, you could keep it open and just put through minimal, low-value transactions on it just to keep showing activity, because this will only serve to improve your credit score. The final points to remember for this video are that your credit score is not universal. Different credit agencies may use different metrics and attach different weightings to these metrics in order to score you. So having a perfect score from one agency doesn't mean you'll have a perfect score from another agency. Check your score often and keep track of any changes, especially if you're going to make any new credit applications anytime soon. I'll link below a couple of websites you can use to check your credit score. You can usually check the score for free, but viewing a detailed credit report might cost extra. Ultimately, a credit score is a way for a lender to measure how risky you are as a borrower. The less risky you are, the more lenders are willing to lend to you and at a better interest rate. Thanks for watching, and I'll see you in the next video.